Hey guys, welcome back to the channel. Montana here, and on today's video I'm going to be talking about continuation patterns. Now, continuation patterns are exactly what they sound like. Price is going to continue in the direction that it's going. Now, last video I spoke about reversal patterns, which are rally-based drops and drop-based rallies. Continuation patterns sound pretty similar, but they're very different. A continuation pattern to the upside is a rally-based rally, and to the downside is a drop-based drop. Now, the reason this is so important for anyone to know whether you're trading, actively trading, or passively investing, it's the same thing. As I've said before, a chart is a chart is a chart. So knowing what these structures and what these patterns mean and what they and where they tend to be created is pivotal if you don't want to be caught on the wrong side of a trade. Now, the reason this is so important for you to know is if you're already in a position and you want to let runners run, you don't want to leave money on the table, then you should be looking for continuation patterns or see what price is giving you. And if it does give you a continuation pattern, then let your position go. It's going great. It's giving you exactly what you want to be seeing. Conversely, if you want to enter a position, and whenever you do, you should be looking to go into a position, long or short, going against the direction that you want to go. So if you want to go long, you want to be catching price when it's falling. And if you want to go short, you want to be catching price when it's rallying. What happens if you see a continuation pattern right in front of the area that you want to go into? That means it's going to continue going against you. So this is a fantastic it's a fantastic structure for you to know and understand so you don't get caught on the wrong side of a trade. So let's get into it. Continuation structures to the upside look like this. This is a rally-based rally, and to the downside, this is a drop-based drop. Now, if you haven't seen my first video, or if you don't know how to read candlesticks, check out the first video. Open, close, high and low, all that good stuff. And if you want to know what constitutes basing, my very last video on reversal structures, I go over that, and it ties into market transactions and what's happening behind the candlesticks. So here you have an impulse move to the upside, basing, and then an impulse move to the upside. Now, as I'm going to talk about on the very next video, this is just a pocket of air. This has nothing in it. Basing, you have a balance in price and then an imbalance. And by balance in price, I mean a balance of supply and demand. Hence why it goes sideways. It has no direction. It's balanced. And then you have an imbalance. If you have an imbalance to the upside, then you have demand here. Same is true to the downside. Here you just have an impulse move down. You have a balance of supply and demand, and then an imbalance of supply and demand, and it's an imbalance of more supply right here. Hence the second leg to the downside. Now, if you look at the structures that we discussed last video, this is a drop-base rally and a rally-base drop. So if you have the first leg, a drop base, and if it's going to reverse, it'll break back above the basing. And to the downside, if you have a rally base and if it breaks below the base, then you have a reversal to the downside. Continuation is not a reversal, it's a continuation pattern. Hence why you have a rally base, and if it breaks above the basing, then it's going to continue. To the downside, it's exactly the same. You have a drop base, and if it breaks below the basing, then it's going to continue to the downside. Hence why that's, on a reversal pattern, you have drop base, and then if it was continuation, it would be another drop. But here you have a rally. Notice they all have basing. Here's on my cursor B, 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 and B. The first two stages are exactly the same. A rally base, and then if it's a reversal, it's a drop, or it's a rally base drop. And here to be a drop base rally, but it's not. It's a continuation. So it continues going past the basing. So what does this look like with more realistic candles? I know we just discussed what it looks like in theory on a poster perfect representation of what price should look like, but let's check it out with a bit more of a realistic scenario. This is an uptrend. Price is going up, and notice how you have rally base, rally base, rally base, rally base, rally, big time basing, rally. You get my point. Price is continuing to the upside. It's in an uptrend. In a strong uptrend, you should be seeing rally base rallies. Conversely, to the downside, you have a drop, base, drop, small basing here, another small drop, base, drop, base, drop, base. Again, you get my point. Price is in a downtrend. You should be seeing continuation. Or if price is going to continue falling, you are going to have continuation patterns, which are drop, base, drops, or rally, base, rallies. Now, what does this mean in terms of you already being in a position? I know this looks like a lot of candles, but let's just focus on a certain example. Right here, you have a beautiful rally base, this candle right here, and then rally. That's a good demand zone. That right there, there's an imbalance of more demand than supply. That's a good area. Now, when price enters that area, what makes price go up? More demand. So when price rallies. So if you are in this position here, and I know it didn't quite touch, but for the sake of argument, if you're in this position and price is going, you don't want to leave any money on the table. You want price to continue, and you don't want to cash out early. You want to catch this entire leg. So logic dictates that you want to buy in demand and then sell right before it gets into supply. And then the origin, as I've discussed in prior videos, the origin of every large move to the upside or downside. So this is an origin of this leg to the downside. There's more supply here. So you would want to buy in demand and then sell right before price gets into supply. That makes perfect sense. But if you get a rally base rally right in front of a supply zone, that's telling you that it's going to continue. And no surprise, when price falls into this area, it continues. Your next area of supply is the origin of this rather large leg right here with a rally base drop. Hence, that's a reversal structure or reversal pattern. So you're worried that price might turn from this area to the downside. But if you get a rally base and then it breaks above this basing, the high of the basing, it's going to continue. Hence, let profit go. Let this thing continue going. Continuation patterns are important, and they tend to exist in very specific areas time and time again, which we're about to go into. Let's just say that you are willing or you are interested in shorting an area of supply like this and that we just discussed. That would make perfect sense. That's a very logical assumption to do. Area of overwhelming supply, you'd want to short next time price enters an area where there's overwhelming supply. So to keep you from going into a position where you're going to be stopped out, you should always trade with the stop loss. To keep you from going into a position where price is going to not go your way, you will often see areas of basing right below or right in front of your area of, in this case, supply. And then they also tend to give you very good areas where price goes. But again, I'm about to cover that in a few minutes. So that'll help you understand if you're already in a position. Continuation patterns tell you, hey, you're doing great. It's going to continue going your way. Or if you want to counter where price is going, like if you want to go short, you got to wait for price to go up because supply is often high. In this case right here, if you see a continuation pattern or basing right below your zone or right in front of it, not a good deal, not a good short. So just wave price goodbye and don't get caught up in that mess. Let's check the other way around. Here you have a downtrend, and this is the first image that I gave you at the beginning. So here you have a downtrend. You have a rally, basing, and then reversal pattern, drop, and then continuation pattern, drop, base, drop, base, drop, base, drop. Let's just say that you got in at the high of this swing high. Let's just say that you shorted here. Logic dictates that demand exists right in this area because this is where price reversed to the upside. It's the origin of a strong impulse move to the upside. Hence, there's more demand here. So you'd want to, if you're short here, you'd be interested or you'd plan to buy to cover or get out of your position or exit your position right before price enters demand because price should bounce or should rally after it enters an area of demand. But if you see a drop, base, drop, base, drop, base, drop, it's going to continue. And if you see basing and then a drop right before or right in front of your demand zone, that means stay in. You're doing great. Price is going to continue, so you don't want to leave money on the table. And then you get another area, and then you get some more basing in your zone, and then it breaks below the basing right here. The high of the basing is here, the low of the basing is here, and it breaks the low of the basing, it's going to continue. Now, if you're interested in going long here and you see a drop, base, drop right in front of an area where there's more demand, that's price is telling you it is going to continue to the downside. So not a position that you're interested in going long simply because you understand that a continuation consists of drops, bases, drops, bases, drops, bases, drops, bases. Plain and simple. Now, how does this apply to real life scenarios and real candlesticks? Let's check it out. So last video, I gave you a small tidbit or a small snippet on the GameStop trade, where a lot of amateurs got in on this first leg, this big rally, and where professionals get in after they've been given a zone. And this is a rally-based rally. There's a balance of supply and demand, hence prices going sideways, and then a massive imbalance of demand because price moved ballistically away from that area. Well, what happens when price enters an area of overwhelming demand? Price goes up. Professionals caught this second leg. And I'm showing you this because I did give you the tidbit on last video. This is a perfect example of how rally-based rallies are, one, a continuation pattern on that first leg, but they also give you fantastic areas of demand, hence giving you this leg. So let's talk about, on a real live chart, not live, but on a real chart, if you're interested in shorting, how you should keep your eyes open for rally-based rallies. This is a drop-based drop, right? So you're interested in shorting this area of supply, and this is the origin of a pretty significant move to the downside. So that's also an area of overwhelming supply. So if you're interested in shorting right here and price is rallying, base, rally, that's already telling you, hey, maybe not the best option. And then it continues to base right in front or right within your zone. If you shorted and the price is does not immediately, there we go, I can talk today, start falling, because you should get reversal patterns in areas of overwhelming supply or demand. I also spoke about that on how to understand candlesticks for beginners video, so you can check that out. But you should be getting, just like you got ballistic movement in, you should get ballistic movement out. If price is basing within your zone, then you're getting a rally, base, and if it breaks above the base because it's going sideways here, then it's going to continue. What's going on here is, and it ties back to the video on transactions, right here, because price is staying here for a long period of time, the market, or buyers and sellers, particularly buyers, have more time to eat away at the overwhelming amount of, amount of sell orders that exist in this area. If price falls, then it doesn't have time to chew away at supply. It's chewing away at supply, which is why it continues to exist there. So then you continue to the next one, and here you also get basing within this zone. Now, let's just say that you're long here and you get rally, base, rally, price is looking good, or it's looking great. And then some more basing, you're looking good. But if you want to short, looking bad, that's a bad go. Last example, you have a rally, base, ballistic drop. That's a good area of supply. What happens when price re-enters an area of supply? It should fall. But in this case, you have a rally, long basing, right below or right in front of your supply zone. And if it breaks above the basing, it's going to continue. So that keeps you from shorting an area that you definitely should not be shorting. Let's go to some examples that are long, or a few long examples. This is the origin of this leg. Pretty decent demand zone, not bad. But if you have a drop base right in front of an area of demand, it's chewing away at these demand orders, at these buy orders. And then if it breaks below the basing right here, then it's going to continue, hence a continuation pattern. You don't want to see that if you're planning on going long. You do want to see that if you're already in the short, which you should have been right here, and I'm going to be going over this scenario in a second. This drop, base, rally, reversal pattern, we discussed that, is a good demand zone. And here you start getting drop, base, drop, base, drop, base right in front of your zone, and also right in this one, and it breaks below the basing, let price just walk right by you. You don't want to be buying this because this is a continuation. It's going to continue to the downside. And look how this whole leg to the downside is riddled with drop base, drop base, drop base, drop base drops, because it's a continuation pattern. It's continuing to fall. This demand zone here, You also were not interested in taking because you had a drop base drop right in front of your demand zone. So that'll keep you out of those positions as well. Now let's go over what it looks like to already be in a position. Here you have a drop base drop, small basing, drop base drop. When price re-enters an area of overwhelming supply, again, it didn't base, you had ballistic movement out. So this is where drop base drops, this imbalance of price, balance of price, and an imbalance of price creates good areas of supply. These are fantastic areas for you to look to enter a position. So drop base drops, that's an area of supply. You come here, drop base drop, that's another area of supply. And then when price re-enters an area of supply, it falls. Now, drop base drops and rally base rallies always tend to exist in areas of opposing demand. There's demand here, the origin of this leg, no coincidence. And you'll see this time and time again, where this supply zone happens because it happens right in front of an area of opposing demand. It has to break it. And this is the imbalance that has to, by mechanical function, it needs to break through those orders. So it needs time for price to be there for a while to break demand and then break demand by that fall, thus giving you an area of imbalance of supply. When price re-enters it, ballistic movement down. Again, you have a perfect reversal pattern right there, so on and so forth. And the same thing applies, again, you see this drop base drop. Did it happen in an area of demand? Yes. Time and time again, they exist in areas of opposing, if it's to the downside of opposing demand, or if it's to the upside of opposing supply. Another example, and this is the one I told you that you'd be in. This one, you have a drop base drop. No coincidence. Because price needs time to spend, like these three green candles, needs time to chew away at those orders of demand, or at those buy orders, and then break below. By definition, it's going to give you a drop, a balance of supply and demand, and then an imbalance of supply. So when price re-enters that area of supply, you get a reversal pattern. Again, last video, and then continuation to the downside, giving you a drop, base, drop, so on and so forth. Now let's look at what that looks at to the upside. Here you have a rally, base, rally. There's an imbalance of more demand than supply there. So when price re-enters that area, you go. I'm going to skip this because this I wanted to discuss. And again, it kind of ties into what I said at the very end of the last video with basing. But here again, perfect example. You have a rally, base, rally, giving you an area of overwhelming demand. When price enters it, you get this whole leg. Now this is also a rally, base, rally, and then it's got like 20 other rally based rallies. But when price comes into an area of demand, you should be looking, and again, I've said this, it's when there's overwhelming demand, you by definition have volatility because there's a massive imbalance of price, making price move to the upside and then fall and then move back up again. What does this look like on an intraday chart? And I know I haven't explained timeframes yet, but I'm going to soon. So tying into what I said on here, you have some basing. And then when price breaks above basing, on an intraday, what does it look like? The demand zone, in this case, it's a rally-based rally because it's a continuation pattern to the upside. They also, they not only keep you from going short, which is a bad idea because it's going to continue going up, but they also give you good demand zones. No coincidence that rally-based rally, when price re-enters an area of overwhelming demand, that also broke above the high of the basing, price goes. And within a larger time frame structure, this whole basing here on a daily is this area right here, right? I know it's green, but just ignore that. This drop base rally reversal pattern is a good area for when price comes back down into that area of demand, it rallies. And in this whole area, this is the demand zone that is clearly marked. I can't get a boost of this as demand. It's right there. This is the origin of a ballistic move to the upside. More importantly, ballistic right here. And it also contains a rally, base rally right before your area of supply. Your area of supply was right here. Hence telling you price is going to continue to the upside. So you do not want to short this area. And then also when price came back down into this area, it it rallied. Well, back to what I was saying on why drop base rallies are good reversal areas when price re-enters. Right here, wham, to the upside. So last video, I talked about reversal patterns. Fantastic to know on when price drops bases. You're looking for whether price is going to break below the basing to continue to the downside, or rallies above the basing to give you a reversal. Hence why the basing is always in the middle of, drop base rallies and rally base drops, which are reversal patterns. And they also have the basing on continuation patterns. Rally base, and if it rallies, it's going to continue, or if it drops bases and then you wait, if it drops below the basing, then it's going to continue falling. So if you're already in the position, look for those structures, and they always exist in areas of opposing supply and demand. And then that also covers your butt from not going into those, or not going long or going short, those areas of opposing supply and demand, because by all rights, if you choose good areas, which we'll be covering on how to get, you would be interested in taking. But if price is going to arrive into your zone and then chill there for a while, or right before it, price is going to continue. So I hope this was informative. My next video, I'm going to be talking about pockets of air, which are those impulse moves. That drop or that rally, it's a pocket of air, and then you get basing and all that stuff. Once we cover that, it's going to tie everything together. I'll see you guys on the next one.